when the Dow peaked in 1929, it dropped 17% in about 4 weeks, almost 17%, rebounded back up just a little bit, and then the bottom fell out of the stock market, and the bottom began to fall out of it in October 24th, 1929. Today is October 24th, 2025. Before you get the bottom falling out of it, you get this big sell-off first and then a rebound. But again, it moved back to the 200-period moving average. Over 10 weeks, it dropped 46%. NASDAQ, during the bursting of the tech bubble, NASDAQ Composite dropped 42%. NASDAQ 100 dropped 40% in 9 weeks. Include the top there as the reversal bar, it's 10 weeks. But from that top, the following weeks, it was 9 weeks. The 2007 top to the 20%, to a 20.5% crash, Fed to panic, dropped 14 weeks. Dropped 9 or 10 weeks, and we peak this week, next week with the Fed, which you're going to peak with the Fed here. See what happened in 2007. Watch the video all the way through. Here, NASDAQ dropped 40% in about 9 or 10 weeks here. Dow lost, 46% in 10 weeks. We lost 20%, 20.5% in just over 14 weeks, 2007. I think that all pushes us to January if we reverse off major resistance, which we're slamming into yet again. They're acting like it's the buying opportunity of a lifetime as we slam, and at least that's what they are, the things that they're saying on social media, slamming into major resistance. Watch this video all the way through. I wanted to show you again, with the bursting of the tech bubble, 40% drop in about 9 to 10 weeks. NASDAQ moved back to its 50-week moving average. The Dow moved back to its 200-week moving average. I'll show you what happens if we move back towards those 200-week moving averages. And where does NASDAQ go if it drops 40% right now? I think you'll find that interesting. I think the S&P is going to get a 20% crash or more, probably more. I think it'll be bigger than sell-off from February down to the April low. And I think that will be down at least 20% by January. Watch the video all the way through. You'll see why. I got amazing charts for the NASDAQ to show you. Watch the video all the way through. And I'm showing you this because if we see a peak here in October, 10 weeks forward is January. Watch the video all the way through and you'll see what I mean. We broke to a new high. I warned about that in my last update. I warned about it all week that was possible. Double top often has a higher high because, again, the big money comes in and they take out the shorts, they take out the stops right there, and then they push it down and they take out the longs. And that's why double tops usually have the second peak higher. Sometimes they're lower highs, but more often than not, they're higher highs with double top patterns. Possible head and shoulders, that's now evolved into a double top pattern. You got that with the CPI, and you gapped higher, you're up about just over 0.5% higher and coming into major resistance again. The CPI came in cooler than expected. The year over year came in at 3%, supposed to be 3.1%. That's still higher than the 2.9% from the previous month, but came in better than expected. The monthly numbers came in better than expected, by the way. And the year-over-year numbers all came in better than expected. Headline numbers still ticking up. Core is ticking slightly lower. It dropped to 3%. It was supposed to be at 3.1%, and the 3% is lower than the 3.1%. And again, the narrative is, inflation's going back down. Inflation's not going back down. Bond market's now buying into this. The 10-year yield was up today. Bullish divergences. Bullish divergences on the RSI, the MACD. Last time you had this happen, you saw the yields surge. When that happens, more often than not, when there's a negative correlation, more often than not, between the 10-year yield and the market, in 2022, we saw the yield surge, the market collapsed. A bullish falling wedge, bouncing off a major trend line of support in the weekly time frame. Yields go higher, that could be a catalyst for the market going lower. Also, the dollar has bottomed. The dollar flat today. You better take heed to the warning of the dollar and the 10-year yield because, again, when they've surged in the past, like when they bottomed out and began to surge, we had the 2022 sell-off, financial crisis, and so forth. I think the dollar is going to surge. It's bouncing off the major trend line of support. The dollar not buying into the inflation report, 10-year yield, the bond market. The big money, they're not buying into this. The Kool-Aid drinkers and the herd, oh, it's a breakout as we slam into major resistance, buying the top, but the big money's not buying into it. The dollar's going to surge. The 10-year yield's going to go higher. They do, we could sell off in the market. Watch the video all the way through. I need to share with you important things about the NASDAQ. 100 has this broadening formation. This is a reversal pattern. NVIDIA has the same pattern. Here we've gapped higher. We've gone to just above the trend line right here. But if we look at it on the weekly chart, we're really pretty much right at it. Now, when you look at NASDAQ's broadening formation in the weekly time frame, if I exclude the shadow right here, just taking it from the candle here, touching this candle here, excluding the shadow, touching this peak right here, again, it's come up to where that level is, regardless whether we've overthrown it or whether we have a better line here in the weekly time frame. It doesn't matter. You've still got the same pattern, even if it is an overthrow move. You're doing that, you're getting this divergence right here. As what I want to draw your attention to is the 200-week moving average, horizontal support, and the lower boundary of the broadening formation. When you keep this in mind, the MACD hasn't rolled over yet here, but look at this. This is a multiple point negative divergence here on the histogram. And again, if it goes negative, the MACD is going to roll over and you're going to start moving back towards the 20-week, moving back to the 50-week. I think you're headed back here once we top, whether that is this week, next week, or in the near future. Again, I think you're going to be headed back to this level. Again, I want to zoom out on the NASDAQ, and I want to show you the channel. Again, these channels going back into 2020, really with the NASDAQ right here, this longer-term channel really goes back to the 2018 low. And what's fascinating is if you connect that 2018 low to the 2020 low, it's pointing up to this area here, around the 13,000 area. Now, if I've drawn a parallel boundary up here, and if you connect that to where we're at right now, to the upper boundary of the broadening formation, again, we're in the weekly time frame. This is our linear scaling, which is fascinating. If the broadening formation ends up playing out, giving us another sell-off and starts being the reversal pattern, which I think it is. I think you have a broadening formation that will eventually set up a head and shoulders on the S&P. I think you'll see the broadening formation go down towards the lower boundary here, or the 200-week moving average. Look at that. Look where the 200-week moving average is. It's near the lower boundary here and near, look at this, horizontal support. This is where we bounced off of. When I called the bottom on the NASDAQ over here, this is the level that we were at. You had Kramer and everybody saying, oh, yeah, we're going to have a Black Monday. Black Monday is going to happen. Down here at the bottom, after we've dropped nearly 26%. Black Monday is going to happen. First of all, the waves of selling are likely going to come in two. You're going to have a big sell-off. It'll be bigger than the 26% sell-off that we saw when the NASDAQ had the bursting of the tech bubble. It was 42%. You're going to have a sell-off, and then you're going to get a big, big rebound. You're going to sell off some more. But here's our broadening formation outlined in red. Here's our horizontal support. And if we were to see a drop down towards the 200-week moving average, I've marked that right here. That would be a 38, just over a 38% drop. If you drop back down to the April low, and let me just bring it up here. If we drop back down to the April low, and the 200 period moving average, you're looking at nearly a 35% drop. That's what we did on the S&P during the pandemic. Now, this 38% drop from the high down to the lower boundary of the broadening formation, 38%, this is the exact same amount that we dropped right here in 2022. From the November 2021 peak down to the 2022 low. Very similar. So if we drop something like that, like 2022, I think we could do it faster than we did over here. That took over about a year to do that. I think we'll do it much, much faster. The NASDAQ bubble burst in 2000. In about 2.5 months, you dropped 42%. When the bursting of the bubble happened in 1929, you dropped 46% on the Dow in 10 weeks. So again, I don't think it's unreasonable to think that we're going down to the 200-week moving average. Now, if you go under that, again, the lower boundary, the broadening formation is at 38%, and that's what we had over here. If we get something like what we had with the bursting of the tech bubble, or when the Dow began to crash in 1929, 46%, NASDAQ dropped 42%, if we get something like that, you come back down here and you can get a 47% drop if you come down to this trend line right here from 2019 and 2020, and that trend line, and it's a perfectly parallel channel. So it's just a channel I'm looking at. Now, broadening formations, they often get these partial rises. So if you get a drop down into the lower boundary or down to the 200 or something, I would be looking for a partial rise. This drop is probably going to happen faster than the drop over here. And again, you're probably going to see this going into January. We top this week, right now, 10 weeks going forward is the first week of January. If we top next week with the Fed, going forward 10 weeks is the second week of Fed meetings this week. We got one next week. We've got one on December 10th. I think you're going to see quarter point cuts at both of those meetings. I think both of those meetings are going to be associated with counter trend rallies that are tops, just like what we saw in 2007. We go into January of 2026, and this is where I think the Fed is going to panic, and I think it's going to be in January that we're going to see the emergency cuts. I think that the recession will have started either in December or January. The market will peak a couple of months before that happens, about, again, 10 weeks or so, 2.5 months or so. Begin to decline, the Fed will panic, and they'll cut rates, and the stock market is going to be sharply lower by January. Yes, I know the stock market went slightly higher, still slamming into major resistance. It changes nothing. The fact that the Fed is started to cut should be a huge red flag for most people about to move into recession. That's what happens either when the recession starts or right before the recession. Before the recession, the stock market begins to price it in, and you get a 20% drop or more. I think you're going to get a bigger drop than what we saw from February to April, bigger than 21% on the S&P, bigger than almost 26% on NASDAQ. But by this meeting, January 28th, is the Fed announcement and press conference, and I think the Fed on that day is going to panic, and for that day, I should say, you'll still get a larger cut, but before the 28th, you're going to get, before this meeting, an emergency meeting, likely 9, 10, 11 weeks from now, you're going to get it, and that puts us into January. You're going to get an emergency meeting out of the Fed where they're going to do an emergency cut before January 28th. They're going to do an emergency meeting, and they're going to cut either 0.5% or 3/4. Powell's concerned about his legacy, so it's probably going to be 3/4 because he's blown it. He should have been cutting rates long ago. He kept rates too high for too long. Just like back when we got the inflation, they kept rates too low for too long and kept telling us inflation was transitory. The Fed does everything backwards because they're a bunch of Keynesians in front of them. Before January 28th, you're going to get an emergency cut out of the Fed. Now, when the Fed in 2007 kept telling us that we weren't going to have a recession and we were going to have a soft landing, they began to cut rates. We went higher, and then we began to sell off, and the second cut was associated with the lower high that set up. Now, we've gone to a new high. So again, the cut that we're about to get next week is going to be associated with some kind of top either this week or next week in all likelihood. Okay? And it was associated with the peak, and you ended up getting with the October sell-off, you got a sharp decline, you rebounded, and then we got the December cut, another quarter, each of them were a quarter, and that was associated with the top, and then you collapsed, by 20.5%, and this is where the Fed panicked right here on January 22nd, 2007, and they started doing, it had an emergency meeting, and they did 0.5% cut. 2001, they started with the emergency meeting, and they did 3/4. Here we got the start in September, the market went higher, and then it began to collapse. You got these other cuts, and then the Fed realized soft landing fairy tale was living in fantasy land, and they started aggressively cutting. And they cut right here, January 22nd. That was about a week and a half before the Fed meeting. And then they did it again. Here's the regular Fed meeting. They did another 0.5%. So you got 1% cut in January. I think you'll get 1% or 1.25% in the month of January. You're going to get jumbo cuts. And then the market sold off with that too. And it went down to test that low, that January low. And then they did another jumbo cut at the March meeting, 3/4 this time. And the market rallied back up to the 200 period moving average. Too late though, by the crash. The 50 had already crossed to 200 here in the daily time frame. I think that the October cut and the December cut are likely going to be associated with counter trend rallies. The market's going to throw a fit until the Fed does jumbo cuts, and I think you're going to get your emergency meeting in January. Now, January 22nd, 2008 is where we got the emergency meeting. The next week and a half later, on January 30th, was the regular Fed meeting, and we got that another half a percent cut. Look at the January 2008 calendar here. You can see the Fed meeting was the 30th right here. That's the Fed meeting right there. And they did the emergency cut on the 22nd, which was right there, about a week before. Let me just say this quickly. With the bursting of the tech bubble, it was about 9 weeks with the NASDAQ 100 collapsing in 9 weeks or 10 weeks from the high, where you had that 40% collapse. With the collapse of 46% with the 1929 crash, it was 10 weeks. Here from the 2007 top down here, it was approximately 14 weeks. Very close, very similar, but a little bit longer. So 9 or 10 weeks with the bursting of the tech bubble, 14 weeks here with the kicking off the financial crisis, the subprime mortgage crisis started it off there. 10 weeks with the 1929 crash. So again, you get the idea. I think, again, going to the January 2008, again, they cut right here, an emergency meeting right there, and then they had their Fed meeting right there. They cut right there. This was just over 14 weeks or so. We go out 14 weeks, you're looking into February, the beginning of February. In all likelihood, I don't think we make it that long. I think you see this happen by January. Our meeting is January 28th for the Fed in 2026. Here's the January 2026 calendar. And here is that meeting. I think sometime before January 28th, you're going to have an emergency meeting. If we go forward 10 weeks, say we peak right here and now on Friday, you get something more like what we had with the bursting of the tech bubble, which is 9 or 10 weeks, or more like collapse in 1929. Then you go forward 10 weeks from right now. If we peak today, you're looking at January 5th. Okay, I think that, and if you peak the week of the Fed and you get a sell-off like we did in 2007, you're pushing it forward another week for 10 weeks or so. From next week, we'll have 10 weeks going forward. That'd be the week of the 12th here, or at the 11th to the 17th, I should say, if I include the whole week, not just the trading days. But when the Fed cut in 2007, they did it the week before. So I think that you're going to, and again, they did it right before, the week before, and then they did it the following week. So I think that you will get, and right here we have New Year's Day, the market's going to be closed, and then you're going to get a partial day, abbreviated session, I believe, half day on Friday, January 2nd. So I think the first 2 full weeks to the half week after that, I think sometime between January 4th and January 21st, you're going to get an emergency rate cut out of the Fed. You're going to have an emergency meeting, and you're going to have an emergency cut that's going to be 0.5% or 0.75%. I think you're going to get another 0.5% or 0.75% on January 28th. And again, it might be 3/4 that we get the first emergency cut, because Powell's likely worried. He's going out the door in May, and he's probably worried about his legacy. He's probably going to be more concerned about trying to aggressively cut rates. Thought about that before he was worried about the tariffs. And think it through just for a second. Back when inflation was soaring to 9%, the Fed was telling us it's transitory, and they were dovish. Now, hawkish, keeping rates too high for too long when we're about to start a recession. In 2007 and 8, inflation soared higher. It was higher than it is now. The Fed was doing jumbo cuts, and their soft landing fairy tale didn't work out. And it's not working out this time either. Just Kool-Aid for the herd. Experts love to talk about that on the financial channels to make them sound like they're just so intelligent. No, I think we're going to get a soft landing. It's made up. Nevertheless, I digress. I am predicting that you are going to get an emergency cut sometime between January 4th and January 21st, 1 week ahead of that meeting. In that 2.5 week window, you're going to get a jumbo cut. I think that by January of 2026, in that window, the stock market's going to be down greater than 20% on the S&P 500. I think it's going to be bigger than 21%, which was our previous decline. I think it's going to be a bigger drop than that. And if we drop back to the April low, you're going down 29% on the S&P. I think 34% or something like that on the NASDAQ. Predict that by January 4th to January 21st, you're going to get jumbo cuts out of the Fed. You're going to get an emergency meeting out of the Fed. And I think that the recession will have already started in December or January, be starting in January, one or the other. I'm not going to say it right then. 8-9 months from now, the economic data will show that it started in December or January, getting the rate cuts. So again, it's likely that this is going to be that the recession starts. And if the recession is starting, the stock market's going to begin to price that in. People think that's possible. The biggest bubble in history. January 4th, January 21st, that's when I'm predicting we're going to get the cuts. And I think you'll get a bottom in the stock market and a massive rally, but I think you'll be down by more than 20% at that time on the S&P 500 and the NASDAQ. Bitcoin likely collapse by more than 50%. When it peaked in 2021, by the time it was done with the first leg down, it had dropped 52%. Quickly, back to my NASDAQ chart. Again, a drop from here down to, with the upper boundary of the broadening formation, the upper boundary of the channel, down to the 200, 34%. You go down to the lower boundary of the broadening formation, you're looking at a 38%, very similar to what we had over here. You get moved to the lower channel, you're looking at 47%, and again, dropped about 40% with the bursting of the tech bubble. There's some levels I'm watching: the lower boundary of the channel, the lower boundary of the broadening formation, the 200-week moving average, and horizontal support. That'd be about a 34.5% drop or so. Actually, I think we go back and we take out the pandemic low over here, which is the 2020 low, and the 2019 and 2020 low is this trend line right here. Parallel upper boundary, we're slamming into it just like the S&P 500. This is the linear scaling. Broadening formation plays out. I think you're going down to test the pandemic low. If you get a higher low, well, that's a drop of 73%. That takes you back to 6,700. If you get a higher low, drop less than 73%. If you drop 80%, again, we dropped what did I say, 83% or so, 3.5% with the NASDAQ 100 with the bursting of the tech bubble, but you drop 80%, you're going back to 5,100. That means you take out the and I'll zoom out here, you take out the 2020 low, you take out the 2018 low, 2018 low, and you go just beyond it towards, you're just above the 2016 and 15 and 16 highs before that sell off there. Drop below the 200-week moving average, you stay below it, and that's a 80% drop. It moved on me, but 5,100. Well, we don't have bear markets anymore. Someone wrote that this week. Absolutely incredible. So just some levels: the lower channel line, the lower boundary of the broadening formation, horizontal support, the previous peak over here, that's where we bounced off of. I think you move back down to there, and if you do, you can get a rebound and form a head and shoulders on the S&P. So again, it might be a 40% drop or a 47% drop if we go to the lower boundary, or something bigger if we go down to the channel here. It might be try to bounce around in that 200-week moving average, but that's where I think we are headed, and that's a 34.5% drop from here on NASDAQ 100. When the Dow fell in 1929, it fell back to its 200-week moving average, bounced back up to the 50, and then dropped below it, and eventually they got the death cross in the weekly time frame. Video: if NASDAQ moves back to the 200-week moving average, you're going to get a 34% drop. If the S&P moves back to the 200-week moving average, and we're very, very far away from it. When we were far away from it over here, you move back to it and you bounced off of it. Again, if you do that, you've got a possible head and shoulders possible head and shoulders that I think is likely going to set up here on the S&P, that you're going to come back to this level just above it, just below it, or right at it, one or the other, and get either a lopsided neckline, a slanted neckline, or a horizontal neckline. And I think, again, you're going to be dropping down, giving all this back. I think by January 2017, it took 14 weeks for the 2007 top before the Fed panicked. 2000, NASDAQ had a sharp drop in 10 weeks. 1929, 10 weeks. So again, I'm looking for a move down to the 200 week. If you do that, you're moving down about 27.5%, very close to what we had over here, 27.5%. This would be just a little bit more if we move down to the April low, or just above that to the 200 period moving average. It'd probably be more about 25%. This is absolutely incredible. This is the daily chart on the S&P 500. Talked about the trend lines, and I'll just zoom out for a second and show you in a minute. But this is the upper boundary of the channel, the red trend line. And this goes back to the 2023 low, which we turned off of it, went up to that 2020 channel from the 2020 low, slammed into it, turned off of it, broke the trend line from the May low, which has marked all the lows. We broke it, but it never got confirmed. You never got a confirmed close below 65.50, which is the low of that reversal bar. That's when Trump announced the tariffs coming November 1st on China, 100% tariffs if they don't have a deal, which meeting here next week, so maybe that gets postponed, but there could be another catalyst, even if that's not the catalyst, or it could be a combination of things, assuming if it's delayed, if the meeting goes well. If it's not, then maybe he goes forward with it. I don't know. But anyways, watching for confirmation of that, you never got it, and we rallied back up. Got back above the green or the black trend line on Friday, the CPI rally, and you rallied right up, overthrowing the red trend line ever so slightly, and then closing right on it. How about that? Peak a stinking boo. Now, if we go a little bit higher, you still have the blue trend line if we overthrow this area, but right now, you're going up to this trend line yet again and moving slightly higher. You have a possible double top pattern here, confirmation line at 65.50. Now, make sure you watch this video all the way through. I'm going to be showing you amazing things on the S&P and NASDAQ. Now quickly, if I zoom out here, again, you've got this channel. We're slamming right into it yet again. That was up close on the daily chart. This is the weekly chart. Again, from the 2020 low, 2022 low, 2023 low, 2025 low, horizontal support. That's where we bottom. Perfectly parallel. You're slamming into it. Okay? If we exclude the shadows here, which you can, okay, and the shadow here, you might have a little more wiggle room, but you're also slamming into long-term channel, nearly 100 years old. I put up the 200 period moving average here so you can see. Again, it's right at the support here. It's near the trend line here. I think you're going to come back to this trend line right here, or come back towards horizontal support right here, come back towards this trend line right here, come back towards the 200 period here. And I think, again, you're likely going to form a head and shoulders pattern. And I think we've got a broadening formation on the NASDAQ and NVIDIA. And then I think you're going to be back all of the gains, or most of them, depending on if it's a lopsided neckline, a slanted neckline, I'd say. And I think we collapse over the next 10, 11, 12 weeks or so into January. And I think you come down here to the 200-week moving average and down towards these levels of support. But you're turning, or I should say you've rallied up into, yet again, for a second time, into the upper channel line here. The S&P 500 rallied higher. I told you I could be wrong about this being a peak. We slammed into those major resistance, but we had the sell-off, and we never confirmed the reversal bar that broke the trend line here from the September low, that broke the trend line from the May low, as you're seeing in this video, and broke the trend line from the April low, and we never got a confirmation to that bar. And so we've come back up, possible head and shoulders, but I told you if it doesn't play out with a reversal and a lower high, confirming the reversal bar in the daily time frame, which was this big sell-off, you got a shot at a double top, going back and slamming into resistance, which is what we've done. We've gone about just over 0.5% higher than the previous peak on October 9th. You still may get an October peak either today with the Friday session or on into next week with the Fed. Very, very possible. If you watch the video all the way through, you'll see why. The rate cut we're about to get is going to be associated with the sell-off, all likelihood. Now, the S&P was up 0.79%. It was up 53 points, just slightly above that level, just over 0.5% higher, and 0.6% or so higher, gapping higher. You're likely going to see this gap filled. And again, if you got a double top, then you can move in the other direction. But we're doing that. We're going back and slamming into that channel line in the weekly time frame. NASDAQ slamming into the upper boundary of the longer term channel and the upper boundary of the broadening formation. At the herd going, it's a breakout. You know, when Bitcoin did this October peak and it did it at the August peak, it went slightly higher than that level, and it went higher for a day or two, and then it reversed hard. Right now it's down 18% from that high, nearly 18%. Bitcoin has likely topped. Bitcoin is probably topped before the stock market. You got people going, oh, this proves it. You got people going, social media, here we go. Back to the weekly chart, you got the same people that told us we were going to crash down here at the bottom, at key support, where I told you we had a bottom there, a boatload of bottoming signals. Here, up at this trend line, and this is at this rising trend line, here we're going to crash. Up here, it's a breakout. They're doing the exact same thing that the crypto community just did with Bitcoin. Bitcoin slightly above the previous peak, and they said it's a breakout, slammed into major resistance, yet for a third time. Here we have multiple touches on this resistance level here from the previous touch here, but here we're touching it again all over the social media today, all over the internet. It's a breakout, here we go. And again, Kramer's predicting a Black Monday crash over here. Everybody's going, yeah, that's got to be right. You're going to get a Black Monday crash more likely over here, okay? Black Monday crash where you get this big percentage drop. I'm not saying that. I'm saying you're going to get over the next probably 10 to 14 weeks going into January, you're going to get a move back down of greater than 20% back into this area. That's what I'm saying. I'm just telling you, the very people that were so bearish down here and telling us we were going to crash are the people now telling us we've got this breakout. This is the buying opportunity of a lifetime. That's what I posted on social media today in the monthly time frame. I said, this is the buying opportunity of a lifetime right here. Here at nosebleed levels, you're at more with the most expensive market in history. It's more expensive than 1929. It's more expensive than the tech bubble top. At the tech bubble on steroids, this AI bubble that's been fueled by QE, round of QE after round of QE, and there's got to be a day of reckoning. S&P is going to drop probably 50 to 65%, maybe more. NASDAQ, probably 70 or 80%. Talk about the NASDAQ in this video, dropping 70 or 80%. Where does that take us? Back to these 2020 lows. And I talked about here with the NASDAQ, this video, I'm talking about going back and testing the 2020 low and either taking it out or getting a higher low. Make sure you watch this video all the way through. Here we're slamming up into this channel from the 2020 low. Again, we've gone just over 0.5% above the previous peak. So again, we're still slamming into this trend line. Now I've taken this trend line in the monthly time frame. This goes back nearly 100 years, or really 100 years, because the run up into the 1929 high, you've got 100 years worth of data going. And here we are in 2025. But here's the channel, and again, I've taken this low, I've excluded the shadow here, and I've just put it from this high in 1929, and you're up there slamming up into it right now. Again, I believe that if we go back to that 2020 low, which is right there, that the low with the pandemic, then I think you're going back to this midpoint of the channel. If you get something bigger, then you're going back to the previous highs, the tops of the previous bull markets in 2020 and in 2000 and in 2007, and that was at 1550 and 1575. They're only 25 points apart. And again, you're going to see something like this where you go nowhere for 13 years, where you have a crash or two, and you're going to have a crash or two down to one of these levels. If we go to the midpoint, you get another bull market, and then you probably crash down to the channel line, moving back to test the lows over in 2009. posted this chart, and again, we just moved, just over 0.5%, 0.60% above the previous high. You're slamming into all this resistance. Nothing has changed. All you're doing is slamming into resistance again. And the herd's going, it's a breakout. And this is the buying opportunity of a lifetime they're talking about. Slamming up into major resistance in the monthly time frame, in the weekly time frame, NASDAQ and the S&P 500. This is the opportunity of a lifetime. If I bring it up close, you can see we are a fraction underneath that trend line at the October high. This is the monthly chart. So again, this is the October bar. We were just right at it, just a fraction underneath it, and now we've come up and we've slammed right up into it. That's the trend line. That's the channel from the 1929 high right there. You're slamming right into it. And that is the buying opportunity of a lifetime. And again, you're likely coming back to this midpoint down here to test this 2020 low. It's a monthly chart. Oh, we broke to a new high. This changes it all. We had a breakout. Changes absolutely nothing. Distance isn't magically going away. You're just slamming into it again.